All right, I think we would wait until a couple of minutes after 4 to get started, but I think we've got everybody we need here, so it's right at 4 o'clock. So let's get rolling, guys. So good afternoon, everyone. Welcome to our first quarter 2026 market review. Today we'll take about 30 minutes or so, as we usually do, to discuss where we've been and more time of where we've been, but also where we're headed in the second quarter and beyond. As you can imagine, depending upon how closely you pay attention to things, there's a lot to cover in 30 minutes. So some of the stuff we won't go as deep as we might want to. But you think about what we've got to talk about. I mean, we've got the US-Israeli-Iran war going on. AI and everything around AI and the AI build out hasn't cooled down at all. Market volatility, the Fed holding rates steady for now, oil prices spiking, strong earnings season underway, and that's just kind of to list a few of the things that are on our radar. So we'll go through as much of that as we can. And as always, if there are any questions, concerns, use that chat feature in Zoom. Usually, given the time constraint, we don't get to too many questions during this 30 minutes, but I promise if you do have a question and we don't get to it, we'll get back to you in the next day or two. So please use that chat feature there. But yeah, let's get rolling. I'm Brian Reese, by the way. I don't know if everyone knows me or not, but Brian Reese, and certified financial planner with Raymond James, Corrigan Krause, Raymond James CKE Financial Services, financial planning partner of Corrigan Krause. And as always, I'm joined by my colleagues, Ryan Ironman and Scott Jones. And again, we're here at Crocker Park, full service financial planning firm, doing both corporate retirement plan business and working with individuals, foundations, and families as well. One thing I'll point out that hopefully most people, if not everyone, knows about is that Davia Sweeney retired about a month and a half ago or so, and we had DeCarla Reed join us. So after we did a search, found DeCarla. She's been in the business 20 plus years, and she also had 5 years with Raymond James. So kind of a cool thing that we've got somebody who just needed to come back in and relearn the systems and is off and rolling. And for anyone that is a client that's on the call, she's probably already reached out to introduce herself. So we're super excited to have her in. A little bummed Davey retired, but she deserved it. So I just wanted to make sure everyone knew about that. And then of course, if you need us, jot down emails, phone numbers. You can always reach out to us. We're somebody's always going to answer the phone, and if it's not one of us, we'll get back to you at some point. So again, thanks for joining us today. Next slide though is just a little bit of review of services. I know we go over this every quarter. I won't go into too much detail on it, but just know whether you're a business owner, a plan sponsor, an employee in one of the 401(k) plans, or an individual client, we've got resources that are available to everyone. And as an individual client, remember we've got a written service plan that we use for all clients. So if you haven't seen that or don't remember what that looks like, let one of us know and we'll get you a copy of that. And then the Raymond James app is available to you. I feel like more and more clients are using that. So make sure that if you want to be able to see your account quickly and easily, you just download the app. And then on the Raymond James website, a feature that a lot of people aren't necessarily using yet is the aggregation tool, which allows you to input other assets, other accounts, other debts if you wanted to, all into one place to log into one place and see it all. One of the keys to that is if you've got a financial plan that we've already built for you or started for you, that's going to feed into the financial plan and update on a regular basis. So then when we get together to review your financial plan, all of that information is already in there. So kind of cool. Just remember, you can do that. If you have a question on that, if you haven't done it yet, make sure you let us know because we'll just have to make sure you've got the aggregate kind of turned on, and then you should be able to go ahead and start inputting the information in there. So kind of cool. As for the agenda, I'll cover the market update and one of the key themes. We'll have Ryan Eierman cover the other key theme and the stock market outlook, and then we'll have Scott Jones, as he always does, closing us out with the bond market outlook and a reminder on diversification. So, good reminder because especially in times of volatility, sometimes people want to move money to certain things when they aren't doing so well one place and other things are doing better. But Scott's just going to give you that reminder on diversifying and why it's important to diversify. Um, as far as the market, look back at how we did in the first quarter. Let me before we dig into it, let me just say earnings are the lifeblood of the market and returns. And so far, earnings this year have been better than expected. Um, Earnings growth is up approximately 12% so far for companies that have released earnings, making it the sixth straight quarter of double digits earnings growth. So that's the key. Now, the other things that come into play are all important, and all play a factor. But when it comes to valuations and earnings per share and PE ratios, it's all based on the earnings. And so far, so good on the earnings. By the way, it's a big week in earnings. We've been in the earnings season for a couple weeks now, but big week because we've got five of the seven of the Mag 7 announcing earnings this week. So they're still responsible for driving a significant portion of the market. So it's definitely an important week to keep an eye on those. But looking back at the first quarter, if you can see top line middle, we've got the Dow Jones Industrial Average down 3.5% in the first quarter, S&P down 4.5% or so, NASDAQ doing the worst, down little over 7%, and then the international index leading through the first quarter down 1%. Now remember, in January and February, the markets were flat-ish. They were okay. January, February, okay, until the Iran situation war started late February. So that's when returns started that's where the majority of the losses in the first quarter happened were in the month of March. So February 27th is when that kicked off. So the month of March is where you see most of these negative returns come from. If you look at the 12-month return, so 12-month return on the Dow, we're still up 10%. On the S&P, we're still up 16, and the NASDAQ is up 24, and the international index at the bottom up close to 22%. Now, one thing that's not on here, I'll add just because I've got a cheat sheet in front of me. Year to date, so this is first quarter. Year to date, the Dow is up close to 3%, the S&P 5%, the NASDAQ up over 8%, international index up 5%. So the NASDAQ was the big loser in the first quarter, but now since things have rebounded, the NASDAQ is leading the way up 8% or so. So pretty amazing. But yeah, the early on, everything was looking good with regards to interest rates being lower than they've been, inflation lower than it's been, maybe not quite where the Fed wanted it to be, but lower. Unemployment was still low. It's still low today, in the 4.5% range. So, and earnings were expected to be good. So early in the year, it was definitely very optimistic outlook with that asterisk, like what if something happens like we've seen in the Middle East. So once that kicked in, we still have a lot of those good things going on, but now we've got this, and inflation is rising, probably will continue to rise. The important thing, kind of a no-brainer, I think. The important thing is getting the Strait of Hormuz open. Negotiations seem like they've kind of fallen off a bit. So hopefully we can get back at that, get this all situated. It's going to take some time to open the strait, but once the strait opens up, get goods flowing in and out, and oil and natural gas and all of those things flowing in and out. That's going to be one of the big keys to the market. And I do think, as resilient as the market's been this year, I do think that's going to be one of the keys once we get through it and have some recovery, that the market and the economy should do really well as we expected. And I know Ryan's got a slide on the Raymond James expectations on the market. A little bit further down, I won't go through all the numbers, but a little bit further down in here, I always like to keep an eye on the mortgage rates and the housing market. As of 3/31/25, the 30-year rate was at 6.77, pulled back at the end of the year to 6.25, and then bounced back up 0.25% to close to 6.5 at the end of March. So a little bounce back up in interest rates. And then gold, no surprise here. Gold has done phenomenally well over the last 12 months, close to all-time highs now. It did pop over 5,000, but we're still close to all-time highs. Last 12 months, the return 7%, and then the first quarter up 7%, and then last 12 months up 48%. So if you've been in gold, good for you. That's worked out well over the last couple of years. If you're not in gold and you're thinking is now the time to get in gold from a return standpoint, I would just warn you and say it's already close to all-time highs. If you're thinking about gold as a safety play and you've got a 40-year time horizon or something, then maybe it makes more sense. But anybody that's looking in just to try to make more money than they would in the market, I would be cautious about that. And then last point on here is crude oil. And this year, more so than any other year that I can remember, since the Iran situation started, is when oil prices are typical day has been when oil prices go down, the stock market goes up and vice versa. So this is the crude oil. You can see the return, what it's done, up 76% in the quarter, which is absolutely ridiculous, and then 12-month 42%. And we'll see how quickly once we get through this, how quickly gas prices go down. But I mean, that's the idea: get oil flowing in and out of the Strait, in and out of the Middle East, and the supply should go up, demand remain the same, and gas prices should come down some. Anyway, all right. Last slide for me is staying the course amid geopolitical volatility. Anybody that's a little bit older, you can remember some of these. If you're old enough, you might remember all of them actually. But it lists all of the crises on the left-hand side, ending with what we're in right now, the U.S.-Israel attack on Iran, and then the dates of all of those. And the whole point of this is how has the market performed before and then post any of these geopolitical events. So, you can see the 3 months before, whether the market was up or down leading into it. We were slightly up this year leading into it. And then 3 months after, so for what we're in now, we're going to see 3 months later, we're getting close to that. But you can see how the market's rebounded 3 months after any of these things. And then 1 year after, you can see as well. I mean, some big years up. Cuban Missile Crisis 1 year later up 32. Kennedy assassination up 28. Soviets invade Afghanistan 33. 29% after the Iraqi War. 33% after Hamas attacks Israel. So some pretty big bounces back up. And then the 3-year return after any of these geopolitical events, you can see nothing's negative. Nothing's negative. So I would say that, and most clients are doing the right things, but I would say as long as you're in a diversified portfolio, it's helpful. The market's as volatile as they are. Nobody's doing that poorly, quite honestly. Small and mid caps have outperformed large cap stocks so far this year. So if you're diversified with some mid and small cap, that's helpful. And then Scott will talk a little bit more about fixed income and how that's how that's working and how that's helped portfolios as well. But diversification works, and when things are going phenomenally well in the U.S., it's everybody thinks they should just pile into U.S., but it's also good to remember that international has done well, more short term, as have fixed income's finally kind of pulling its weight as well. So stay invested, stay the course, make sure you're diversified, make sure that we are rebalancing or your current advisors are rebalancing portfolios when they should, when they're out of the allocation range that they should be in. So that's all I've got for you today. I'm going to turn it over to Ryan to carry on with the conversation.
All right, thanks, Brian.
Yep.
So I'm going to talk about the market leaders as of late. The Magnificent Seven is what I'll be touching on here versus the S&P 500. And if you're not familiar with the Magnificent Seven, just what uh, commentators are calling the top seven tech stocks that have been driving the markets over the past several years. So Nvidia, Microsoft, Apple, Google, Amazon, Meta, and Tesla. And then the S&P 500 is the 500 largest publicly traded companies in the US. So it's a good gauge of the broad US markets and how they're doing. So what we're seeing lately with the Mag 7 is that they're actually starting to trail the other 493 names in the S&P 500. If you look at 2023, you can see that all seven companies in the Mag 7 outperformed the remaining 493 companies in the S&P 500. If you go to 2025, just two of the Mag 7 outperformed the other 493. And then so far this year in 2026, none of the Mag 7 are outperforming the remaining names in the S&P 500 index. So it's a interesting trend that we're keeping an eye on here, and we don't anticipate by year end that that will remain the case, but just something to keep an eye on. Then continuing on with the S&P 500, this chart tracks the index back to 1980, so 45 years. And year to date, the S&P 500 is actually up close to 5%. This is a chart from the end of quarter one, so it's showing that it's down 5% there. Um, but yeah, so all the red dots that you see along the bottom is the low point for the US stock market throughout the year. So you can see that every single year there's a major downturn, and then the gray bars along the top are where the market finished for the year. So despite every year there being a downturn, the market finishes positive 75% of the time. So this is really a thing to keep in mind as just a testament to long-term investing and why it's so important to uh, stay invested even throughout market volatility. And then this is the Raymond James outlook for the end of 2026. So each quarter, our team of economists get together and they make predictions on what the US stock market's going to do based on all the data that they have and their forward-looking assumptions that they have as well. So the base case, they're thinking there's a 60% probability that the S&P 500 will finish the year right around 7250. And then the conditions for that happening are the economy remains resilient. There's one additional Fed rate cut by the end of the year. Earnings stay positive, and then the disinflationary trend continues throughout the year. Then if you look towards the bottom, they're saying there's a 15% probability of there being a bear market, and the market finishes around 6,200. The conditions for that would be inflation starts to pick up a little bit, which leads to the Fed starting to possibly raise rates a little in response to that. The tariffs continue to weigh on the economy and margins, and then the economic fundamentals start to soften a little bit. And then over on the right, there's also a 25% chance that we see things improve from our base case, and that we finish the year around 8,200. And then the conditions for that would be the economy starts to pick up a little bit above expectations. We see consumer sentiment stay strong, and then the Fed would continue with cutting rates. So with that, I'm going to pass it off to Scott to talk about the bond market.
Awesome. Thanks, Ryan and Brian, for comments so far. So yeah, just gonna kind of wrap up here the call on some fixed income commentary and some diversification. So we're seeing attractive yields. It doesn't get talked about a lot. It's maybe not as exciting as talking stocks and things like that, but this chart is just showing you the kind of the 15-year ranges of different fixed income sectors. And then the little diamond blue is where the current yield is. So you can think of that as like the interest, really the coupon that the bond is paying, annualized return from the income component. And so if you see the little purple, that's the 15-year average. So, easy to see that the current yield on most fixed income sectors is well above the 15-year median. And so that could lead to, we still have treasuries at 4+%, obviously backed by the full faith of the US government. So safe investment, yielding close to a little over 4%. So, just keep in mind, I know Brian mentioned earlier the importance of rebalancing. We're coming off three very good stock market years from 23, 24, and 25. It's important that, if you're invested in 401ks or IRAs, and it's not in a managed portfolio of some sort, that, you've seen a lot of gains out of your equity positions, and making sure that you're being diligent and rebalancing back to your risk, the target that you're comfortable taking on. So, I think you can see certainly during volatile times, people find we saw a big flight to cash when there was a raised rates in 2022. And people were very comfortable earning 4 to 5% in money market funds or CDs, and we're still seeing that today. But just taking, slightly more risk, you can see some of these yields are yielding in the 5 to 6% range, with very stable like returns. So don't forget bonds as part of your portfolio, and I think as you can see here, they're offering fairly attractive rates, at least from a historical standpoint. So the Fed, next chart we're going to look at is just really the Fed funds rate, and this is going back since 1993. A lot of the news you're hearing about today is the appointment of a new Fed chair. And so they're going through the nomination process on that. And last week they had a hearing, and they were peppering him with questions and stuff like that. But, that's kind of where things stand right now. Raymond James expectation, Ryan talked about, we expect one rate cut. It's likely probably not going to be till later in the year. just because of the nomination process and the FOMC when they meet, scheduled meetings and things like that. So with this chart here, you can see the big spike up in rates in 2022. That was, largely due to get inflation under control, slow down the economy, and then you saw the Fed easing process, um, stop, and then basically, um, you know, we've seen last in 2025. You saw basically about 75 basis points or 3 rate cuts last year. So this is where the market expects the rates to land. You can see in green, but not too much lower than we are today. And then the long-term projections get us closer to probably 3%. So, we do expect that to be a positive for fixed income if that plays out. And that would likely mean that your money market rates and your CD rates and your cash potential of bank savings rates would come down a little bit if those cuts come to fruition. So, but overall, things have been pretty steady there. Couple things on diversification, just kind of our quilt chart. We look at different returns over the years, and this is just ranking asset class from best to worst for that given period of time. Over on the left here, you can see these are the averages, about 15-year averages. The green box is large cap US, so that's the S&P 500 that we're familiar with. That's about 14% per year over the last 15 years. So a little bit higher than long-term historical returns. Small cap was second, real estate. And then this white box is a balanced portfolio, which has about 60% in stocks and 40% in bonds. It's asset allocation. You can see that's kind of diversification. The purpose here is to follow that white box along. And it's never at the top, but it's also never at the bottom. And it's kind of taking all the colors together and making a diversified portfolio. And it's averaged about 7% a year for the last 15 years with less volatility. And commodities year to date over on the far right, Brian talked about oil and gold having strong returns. And that's no surprise that year to date it is leading. And last year it was up nicely, about 15%, 16%. However, if you look long term, it's actually still in the negative from a return over 15 years. So I'm going to talk about that next. But, it's just, again, going back to making sure you're working with somebody, making sure you're in a portfolio that makes sense, it's appropriate for your risk tolerance and your financial goals. And we can help you with that. And many are familiar with those in our 401k plans as well as individual investors. So we get a lot of calls. We have gotten some questions on gold. I know Brian talked about that a little earlier. So I thought this chart was interesting because for a couple different reasons, but you can see on the top left here that gold does tend to perform better in high risk geopolitical environments. And this is going from 1986 to 2025. You can see in a high risk environment, the average return is about 14, 15%. But overall, it's returned about 6.7%. And this chart is through March 31st. So a lot of the run up that we had, pretty significant gains are included in these returns that you're seeing here. But over on the right, this is kind of important. You can see how the yellow gold annualized return stacks up against the light green S&P 500, as well as the dark green balanced portfolio, the 60-40 portfolio. So over this period of time, 1988 to present, it's had a lower overall return with higher volatility, meaning higher risk of market prices fluctuating more. So, even with the big run up that we've seen, if you look long term, this investment has provided lower overall returns with higher volatility. And so it has worked well for a portfolio hedge for diversification purposes, but as a long-term investor, if you have a long time horizon, it has definitely not kept up from a compound growth perspective. And that's kind of where we continue to focus our strategies. So with that, just kind of going through to finish up, if you're a participant or employee in one of our 401k plans, we do offer model portfolios that are packaged for you. There's no additional costs. Raymond James looks at those every year, and we basically make rebalancing decisions as well as tactical, I would say strategic yearly tweaks to those portfolios based on outlooks and things like that. But it's a great way to invest long term for retirement. And if you have any questions, we have similar portfolios that many investors are invested in through funds called like Freedom that Raymond James helps us run. So this questionnaire that you see on the right here, just a risk assessment tool that we go through with employees to try to help them determine which portfolio would be appropriate for their goals. So that's pretty much all we had. I know there's a lot going on. We welcome any questions. There will be a replay of this call that we make available on YouTube, our YouTube channel. There's also, if you're an employee of one of our 401k plans, we work with a service provider called Venrollment that you may be familiar with. We post the replays out on our Venrollment pages for our companies to come back to and reference if they need to. But our contact information is here. We do have the ability to online schedule. If you want us to take a look at things for you, we can be available in person, by Zoom, virtual calls, or by phone. And happy to talk to you further about things if you need so. So with that, I'm going to go ahead and wrap up. We have a couple disclosures as always. We appreciate your time being a client, and we're happy to help you if you have any investment related questions. So with that, thanks everybody. We'll see you in a quarter, and follow us on LinkedIn and some of our social pages. You scan the QR code, it'll take you to our LinkedIn page. You can follow, and we're going to try to post the replay of this call on LinkedIn as well. So thanks everybody.